as to interest rates, I have a suspicion. And that suspicion is that it will be higher not for just longer, but higher for much, 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 much longer. I think we are in a time of persistent inflation, and I think the risks to inflation and to interest rates are to the upside rather than the opposite.
Welcome to Thoughtful Money. I'm its founder and your host, Adam Taggart. Between February 2022 and August of 2023, in order to combat hot inflation, the Federal Reserve rocketed its discount rate from near 0% to 5.25%, the most aggressive interest rate schedule in living memory. Since then, the Fed has kept the rate at 5.25%. This is the higher for longer era. But despite this, even when paired with quantitative tightening, economic growth remains robust, inflation's lower, but it's proving sticky, unemployment remains under 4%, and the stock market is at all-time highs. In short, the Fed's aggressively restrictive policies haven't really cooled things down that much. They've been so ineffective that even the Wall Street Journal is asking, do interest rates really matter anymore? To find out, we've got the great fortune of speaking today with perhaps the world's foremost living expert on interest rates, James Grant, founder and editor of the highly respected market journal, Grant's Interest Rate Observer. Jim, thanks so much for joining us today.
Oh, you are welcome, Adam. Nice to be here.
It's such a pleasure. Always wonderful to talk with you, Jim. Thank you for making the time. I've got a lot of questions here for you, so let's just dive right in. Let me start, if I can, with a very broad question I like to kick our discussions off with. What's your current assessment of the global economy and financial markets?
I have an ignorant take on the global economy. It reminds me of a line of maybe de Gaulle or somebody said, somebody asked him, what about China? He said, big country, lots of people. So as to the global economy, I will pass. As to interest rates, I have a suspicion. And that suspicion is that it will be higher not for just longer, but higher for much, 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 much longer. And this has to do with the observed tendency of interest rates to trend over the course not of fiscal quarters or years, but of generations, both higher and lower.
Okay. So obviously for Wall Street, which has been looking for a Fed pivot and a Fed rate cut, at every moment for the past couple of years now, that's likely to be very disappointing news to Wall Street if your prediction indeed proves true.
Yes, well, Wall Street is very good at ignoring things like this. The Fed has in fact pivoted. Late last year, it began to talk about its imminent movement to reduce interest rates, its policy interest rate, the Fed funds rate. So that the pivot has in fact happened. And now there's some consternation about whether the Fed might have to repivot to something in the way of either a stable federal funds rate at the elevated heights of 5.25%, or heaven forfend to actually raise that rate. And I think it's not out of the question that it will have to raise. It would do so very, very reluctantly. But I think we are in a time of persistent inflation, and I think the risks to inflation and to interest rates are to the upside rather than the opposite.
Okay, and so let's just dig into that. Let's tackle that head on. Why do you think we are in a secular higher interest rate era now than we were, perhaps, say, for the past decade?
Yeah. What preceded the recent march of interest rates to the upside was 40 persistent years of declining rates, not continuous declines, but persistent declines. It began in the autumn of 1981. Long-dated treasuries then quoted to yield 15, if you please, 1.15%. Astounding, seemingly otherworldly from today's perspective. And so what followed was the aforementioned 4 decades of decline, culminating in 2000 and I think 21 with interest rates. The 10-year Treasury was yielding 0.5% for a few hours, and interest rates worldwide were pitched so low that a good number of trillions of dollars worth of securities were priced to yield less than nothing in nominal terms. So I think that I have this observation, which is the significance might be contested, but the facts cannot be, which is that interest rates have indeed tended to trend both up and down over the course of many, many years. Final quarter of the 19th century was down. That was a time of generally falling rates of inflation, indeed some deflation, and they rose the first 20 years or so of the 20th century, the time of rising inflation. They declined during the era of the Great Depression and its aftermath, and then rose for the 35 years from 1946, and then 40 years of decline. So what I think generally marks the end of a long cycle in financial markets is some evidence of seeming of plain undeniable inexplicable excess. So 40 years ago, 1984, the long-dated Treasury was priced to yield 14% at a time of inflation of less than 5%. So something like 9 percentage points of real yield on offer 40 years ago. That was a kind of the retest of the highs in yield, lows in price of that great bond bear market. So that was you look back at that time and it was inexplicable how people could have turned up their noses at you secured 14% for 30 years. That's equity-like returns with no equity. How did that happen? Well, it happened because of conditioned behavior, of conditioned expectation, muscle memory. 35 years of rising rates could do that to a person. And now we've had 40 years till 2021 of falling rates. So I think that that the culmination of that 40-year cycle in the phenomenon of 16 or so $17 trillion worth of bonds yielding less than that, I think that was the signal that we have started something and ended something. And what we ended was a time of what became a ritual, unthoughtful, mind you, not thoughtful, unthoughtful love affair with bonds that kind of almost out of something out of habit. People just, bonds, they go up in price, down, and that's what they do.
Yes.
That's what bonds do for a living. And so it's not so hard to understand why people are wedded to the idea that rates must fall from here. 5.25% seems alpine compared to, shall we say, zero, where rates were pitched for so many years. So I think this is I think that historians will look back on it. I perhaps will not be physically present in 40 years' time to make this observation, but I have deputized my grandchildren in my prospective absence. But they will be charged with what did we tell you?
I was going to say, have you already had your
Yes.
tombstone pre-made and has "I told you so" chiseled into it?
There's one tombstone in New Jersey, and the legend of the tombstone is, "I told you I was sick." I was for the doctors treating the patient. "I told you so" actually is a phrase that I tremble to utter even in jest. It is most unhelpful and most unlucky. And believe me, I don't have no grounds for uttering it. But so that's our story here at Grants. We think that that higher for much, 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 much longer is the theme, unfalsifiable to be sure over the course of many decades, but nonetheless, we are sticking with that as a working hypothesis, not
Okay.
dogmatically, hypothetically.
Okay, so we're going to get into my very favorite topic, which is the lag effect, which is something I talk about on this channel way more than my audience probably wants me to, but I'm very curious to hear.
It's your channel, Adam.
It might end up just being me, a channel of one. But it sounds like maybe you may be on team lag effect as well, meaning at some point these higher rates, these higher for much longer rates, are going to start to bite in ways that they maybe haven't quite fully done so yet. Let me ask you this first, though. You talked about how we rose to this extreme in interest rates in the 80s, and that was about a 35-year period, I believe you said.
Yes.
And we've had a 40-year period of decline since then. Do you see this as like a sine wave or a pendulum? In other words, do you expect things to swing now for another multi-decade rise in the other
I do
direction?
as a shot in the dark, as a a working theme, as something that's grounded in the observation of history rather than any mystical belief in the dominance of cycles. Although I do concede that there is reason to wonder about the cyclical nature of things. It seems quasi-mystical, utterly at odds with the quantitative fixation of so many economists and people who fill formidable papers of analysis, and then at the end there is the appendix filled with calculus and algebra, and these people, it sounds condescending or worse. The practitioners of the scientific wing of the economic science are not alive to the proposition there might be something cyclical. But I think that that finance is broadly cyclical. You go from extremes. Certainly, you've seen it. You have to be so old to have seen it in many asset classes. People go from revulsion at the bottom to euphoria at the top. It's just an oft thrice told story. You see it in credit, perhaps especially. Although housing, mortgages, what have you. So what would explain? What would be the fundamental explanation, looking back on this cycle of prospectively rising rates? What would have caused it to move in that direction? Well, I think what might be the explanation, as we would piece together, is a time of inflation. I see that in many areas. I see it, for example, in the remilitarization of the world. It's not a very pleasant sight, but it is a sight. And the war is maybe next to opera is the costliest of human endeavors, and people are talking about bumping up the allocation to military preparedness to 5% of GDP. I think that's something the Times did, from 2.5 or 2. So I think that that from a fiscal point of view, this striking record of massive 6 and 7% GDP deficits in the face of a sub 4% unemployment rate. These are remarkable fiscal markers of seemingly a determination to inflate. And let us not forget the Fed is explicitly is wanting inflation. It defines price stability as a 2% rate of inflation, which I think is, first of all, is Orwellian, is unhealthy. It's a matter of language. It's kind of a sneaky and unworthy deceit on the part of the Feds. But we as a people seem to want, we vote for inflation. When was the last time you cast a ballot for the Balanced Budget and Gold Standard Restoration Party? It's hard to find in the ballot. So I think the populace, the electorate is voted for it. Might not admit it in just those words, but we elect the people who give us inflation, being a governmental gift. Some gift, thanks.
I love this discussion, Jim, because you are echoing many things that I have said recently. So it makes me.
Well, that makes it not only delightful, but true, Adam.
I don't know if it makes it true, but it just makes me feel smart in a way I probably don't deserve to. But yeah, I mean, right down to the fact that no sitting politician will ever, run on an austerity platform because it would be political suicide for them, and it's not expedient for them and their own personal interests. But at the same time, the populace will never be pushing for a candidate to do austerity either, because as in general, we vote for the people that are willing to give us succor today, and will let the future.
Yeah, the cartoon we have a cartoon on the front page of Brass, just to show the reader that's not all grim out there. In the cartoon, this issue shows a guy sitting up in bed, obviously having had a nightmare. His wife has laid a consoling hand on his shoulder to simmer down, and what he is saying is, I dreamt that somebody won the election. So whoever's going to win is all for inflation, certainly with regard to the fiscal program.
Well, so on the fiscal program itself, it's probably an obvious question, but I mean, are we playing with fire here, running these wartime deficits, at least as a percent of GDP, in peaceful times where, like you said, you can look at the headline data, which I'm sure we can tear to shreds in lots of different ways, but say a strong economic growth, low unemployment, markets near all-time highs. Like, why are we spending at these levels, these emergency spending levels? Are we just, to your point, just setting ourselves up for intractable inflation?
Yes, I think we are setting up for an intractable inflation.
Okay, that's what I like about you, Jim. You don't mince words. All right, so talking about the lag effect, meaning, well, I want to talk about the lag effect in terms of the repercussions that these higher for much, much longer rates are going to have. Before we get there, though, do you agree? I don't want to put words in your mouth, but do you agree that we are going to see a lag effect from the massive increase that we've seen in interest rates? And I know they're a lot lower than they were in the 80s, but the debts are a lot higher. So interest rates bite a lot more today than they used to.
Well said,
because there's a lot of people out there that are saying lag effect doesn't matter this time around. Look at those headline stats I just mentioned. I don't see any problems here. I assume you believe that there will be a price to pay for the tightening policy.
Visible problems are not really worth worrying about. It's the ones you can't see that should command attention. And yeah, by way of a preface, let me confess a few things. I began advising the readers of Grants about the coming cycle in the long bear market bonds about 20 years ago.
So you're early to the game.
That is not early. That is RONG. And there are other sins of omission and commitment. So before embarking on the answer to the question, whatever it was, Adam, I want to be clear that this is not exactly, but this is not necessarily a pinpoint time. It's a lag effect. So one of the things we were early on was saying, well, this is a highly leveraged world. Leverage being a fancy word for encumbered or indebted, and private equity is the figurehead for this. The idea being that you go out and borrow a lot of money and buy a company with that money, and then borrow some more and pay yourself a dividend. Meanwhile, promising to affect great revolutions in productivity and efficiency in the newly encumbered corporation. That's private equity. And it has worked since the early 80s with Bill Simon, since late 70s, maybe Bill Simon is part. I mean, it's been great, but nothing is great forever. And I would say that private equity is the essential point of vulnerability in the lagged effect of these higher interest rates and perhaps rising ones. So another way of answering the question, or attempting to answer it, is to say, what would you bet that the consequences of better than 5 and almost 10 years of interest rates actually at zero from the point of view of the funds rate?
Mm-hmm.
What would you bet that the consequences are benign, thoroughly benign? You can suppress interest rates for the better part of a decade. And the outcome is going to be better than it would have been had you not suppressed them. So I would say the odds on that are nil. I would say that interest rates, and I speak as kind of an interest rate obsessive, hence the name of the publication, certainly an interest rate chauvinist, I guess. But interest rates are arguably the most important prices in finance. They guide investment and misdirected, I suppose. And if interest rates are phony or suppressed, traffic signals of a market economy, perhaps. So I think that's the background. The suppression of interest rates is the background, and the consequences of that are the misdirection of capital and the miscalibration, if that's a word, of expectations and of risk tolerances. So people have been accustomed to benign outcomes because it was hard to go broke when rates are zero and you could refinance everything, and you had to work at going bankrupt. But I think it's going to come much more easily now. And I think that we are setting up for higher inflation. And whether that, by the way, is going to lead to deflationary pressures, and that's a very good question. But we're setting up for higher inflation and the disappointment of people expecting relief from lower rates. And this is going to test a banking system that is very low on a margin of safety, that is vulnerable, especially in the smaller and medium-sized institutions, to these rates, let alone higher ones. So I think that's the risk we have to look forward to. And as you try to balance risk and reward, and we try to look for situations that are going to provide you with a margin of safety. And we do that at Grants. I don't mean to sort of emphasizing the negative here, but I think the risks lie heavily on higher rates and the consequences, lagged consequences thereof.
All right. Boy, I want to get that framed, that last sentence framed, just so when anybody pushes back on me about continuing to beat the lag effect drum, I can say, oh yeah, well, look, this is what Jim Grant thinks. So, in terms of the dominoes that may fall because of these lag effects that we're talking about, you just hit on the first one I wanted to ask you about, which is the banking system, which is a very important component of our entire financial system. And that's where, when things go bad, they can take kind of everything down with them. In your most recent edition of Grant's Observer, you quoted a fellow there named, I'm going to pronounce his last name wrong, but Paul Kupiec? Paul Kupiec?
Yes. Kupiec, yes.
Okay.
Yeah.
Okay. And he's a senior fellow at the American Enterprise Institute. And he says, quote, once bank unrecognized interest rate losses are taken into account, the mark-to-market solvency of many banks, certainly hundreds, but perhaps thousands of banks, will depend on what happens to commercial real estate loan performance going forward. And we all know that that's looking quite dire. Even a modest bank commercial real estate loan loss shock would render many banks market value insolvent. And if they fail, they would likely strain the FDIC's resolution and deposit insurance fund resources. So he certainly seems very worried about this. I interviewed Thomas Honig, who...
Honig, yes.
Yeah, phenomenal gentleman, and I'm sure you're familiar with his background.
Yes.
Yeah, and he also, in addition to running the St. Louis Fed and being a voting member of the FOMC,
yes, yeah.
He used to be a director of the FDIC.
Yeah.
And when I interviewed him, I asked him his level of concern for today's banking system integrity, and he said he was quite concerned. And I said, well, put on a scale of 1 to 5, 1 being everything's fine, 5's being it's on fire. He said about a 4. So, very smart people that understand this industry well are concerned, we'll say. How vulnerable do you see the banking system to this lag effect of these higher rates?
Well, it is vulnerable on, especially so on a contingent basis. That is to say, the contingency being what goes on in commercial real estate, which by the way, was an asset that was forbidden on the balance sheet of a nationally chartered bank until, with some exceptions, until about 1935, when the laws. So the national banking system was founded on the old-time bankers' prejudice against real estate as being inherently illiquid and therefore inherently unsuited to an institution that was susceptible to runs because of the nature of a fractional reserve institution. So that's by way of deep background. But as to the foreground, the most visible area of weakness in commercial real estate is, of course, the increasingly troubling not full American office building, especially in downtown urban areas. And however, there is a great deal of real estate that has nothing to do with that. And it is the kind of real estate that houses fast food restaurants or suburban office buildings that are not 40 stories high, but 4 or 5 or 6 stories high.
Mm-hmm.
And some of this real estate is actually appreciated over the past 5 or 10 years. And so the idea that all real estate is about to collapse is not true. That's what lends the contingent nature to this, is the fact that the rot in real estate is somewhat concentrated in office buildings and less spread out to the rest of the subdivisions of that broad asset class, whether it's industrial or retail or hospitality. But if commercial real estate more broadly suffers a bear market, as it might, for example, in an unscripted recession, then we have to look for more trouble in the banks, especially in the smaller and middling sized banks that have, as it is, hundreds of them without adjustment, have a ratio of commercial real estate exposure to so-called tier 1 capital that is a 3 on the scale of the examiners, which means the examiners should give it more scrutiny because it's rather concentrated. So in summary, what the banking system lacks is a margin of safety. It is fine systemically for now, but it's not so fine when you adjust it, A, for risen interest rates, and B, for exposure to commercial real estate or overexposure to commercial real estate. And what makes it worrisome as opposed to contingently troubling is what would make it so is a much broader real estate bear market and or a recession.
Okay. I do want to talk about recession odds at some point, and obviously higher for longer interest rates. I have a hard time not seeing how those don't increase the likelihood of a recession because they weigh on corporations and households as time goes on. But in terms of commercial real estate, do you see many paths on the future decision tree here where we can avoid taking big losses in commercial real estate? Like it seems like what I hear you saying is banks are doing okay right now unless commercial real estate really starts getting pretty bad for them. Just looking at the trajectory of that, I don't see a lot of candidates that are going to sort of rescue the commercial real estate market in the next 1 to 3 years.
Well, time would. The passage of time would help. So much cyclical precedent has gone out the window in the last 10 or so years. You rule out nothing. And there's nothing is certain, of course. Nothing has ever been certain. But the tried and true indicators of yesteryear seem to be rather less reliable than heretofore. But if you lend money on a loan to value basis of 80% for a small shopping mall that is housing some fairly stable franchise retailers, and time passes and inflation works its wonders, and that property appreciates in value, so suddenly that 80% loan to value ratio now is like 70%, right, or 60%, because the valuation of the property has risen and the debt has not. So that is one way out. But that would presuppose stability in the rate of inflation, which I don't foresee. And again, um, you have to keep an open mind because the capacity of events to surprise, in my experience, is never ending.
Yeah. And let me just interject on that. I mean, I think there's so much that has gone on over the past several years that if you had told me about it in advance, everything I would have predicted would have been exactly wrong. I mean, if you had told me that we were going to hike interest rates as aggressively as we had and then hold them here for this long, and I would have said, well, the stock market would have cratered, the residential housing market would have cratered, corporations would have laid off people by the millions. None of that's happened, at least not yet.
Yes, you must be a reader of Grants, Adam, because many of my readers would have been just as astonished by the turn of events as you have been. Yeah, that one of the things about the this economy of American economy is its resiliency. It's quite a nice characteristic to have. Resilient it has proven. But I don't think that that mere resiliency and mere enterprise and mere elan, all of which America possesses in abundance, is necessarily going to save us from the very formidable arithmetic of interest rates if they persist at these levels, and even more so if they work higher from these levels.
Higher, yeah, exactly. So a few other elements I want to, or parts of the economy, I want to get your opinion on the lag effect, but one last question on the banking system. So, you know, we'll double cross our fingers and hope that commercial real estate doesn't get worse than it is right now. But even just these high interest rates have been really bad for banks, right? I mean, we had the you know, three of the four biggest bank failures happened, you know, just a little over a year ago. And we've kind of all forgotten about it, but it really wasn't that long ago. And we had the BTFP created to basically absorb a lot of the assets that are underwater on bank balance sheets. And while that program has now, quote unquote, expired, you know, everybody that was in it was basically able to kind of continue to roll over their debt there for another year. So if nothing else changes, as I understand it, correct me if I'm wrong, in about a year's time, they're going to have to take those assets back, right? And so if we're at the same interest rates we are today, they're actually higher than they were when the BTFP was created. And God forbid interest rates go even higher, it'll just put those banks those assets even further.
Assuming that the Feds don't renew everything, the Federal Reserve has shown certainly its willingness to help the resiliency project by nurturing its charges, the banks, whenever they need it. You know, the Fed itself, how to say this, is broke. You have to act surprised because this is a bald fact, which ought to be prefaced by a couple of disqualifying or qualifying words. So I will say the Fed is theoretically and hypothetically functionally broke. What makes it, no, functionally is wrong. It is hypothetically broke. And the reason, let me try to expand on this word salad I've got myself into. So the Fed shows about $43 billion in capital. And it has continued to report weekly losses on an operating basis ever since it pushed its federal funds rate higher and higher. So it now is paying 5% plus on its liabilities and earning 3% or less on its assets. And that's no good way to get rich. It has racked up losses, I guess in excess of $160 billion against the aforementioned $43 billion in capital. So if it were, say, Silicon Valley Bank, the Fed would have been knocking on the door of the FDIC. What prevents that is the Fed's ability to journal over these losses to the Treasury. The Treasury has absorbed these losses in a kind of a bookkeeping ledger main prestidigitation, some magic trick to the, so if you look at the Fed's balance sheet, we'll say that in so many words, we owe the Treasury 160 or whatever is $1 billion. So that is money the Fed will repay to the Treasury once it resumes the business of making money by creating money. But the Fed is now in the business of losing money by creating money because it has structured its balance sheet as so much of the American banking system has done. So the Fed, in its hypothetical insolvency, is a living example of what the banking system outside the Fed is up against, right? So the Fed is not only not leading from the front in the safety and soundness department, but it is, in its example, it is showing what has become, what has happened to the profit-making private business of banking because of the interest rates the Fed has imposed over the course of many years.
Wow. So the Fed is the physician attending to the diseased patient, but the Fed is actually got the same disease as well.
Yeah, or it is the arsonist and fireman. But yeah.
Okay. So anyways, I mean, that I guess the crux of my question was, does this higher for much longer interest rate environment make banks more vulnerable, even putting aside the commercial real estate risk, just because of the weight of these higher interest rates with their impaired assets?
Yes, it does. You know, they own bonds, they own leases, they have made loans in the from this time of remarkably singularly low interest rate era. And those loans, leases, and bonds are on the balance sheet. They'll roll off in time. That's why time is a solvent here, is a balm. It's a healing agent. The question is what happens between now and 5 and 10 years from now, when the
Right.
bonds and the leases and the loans will have been renewed and with higher yielding assets.
Okay, so that's going to take me in just a second to the corporate maturity wall that corporate America faces here, where a lot of low yield debt is going to have to start re-rating. It's already beginning to start re-rating at much higher levels. If you're right, this is going to be a very painful wave for a long period of time for corporate America. Let me ask one other question before we get to that one, though, which is...
Let me introduce it. It will be painful except for those companies that show a great deal of cash in their balance sheet and are net interest earners. And that,
sure. So our Magnificent Seven get even more magnificent.
Yeah. So it's
so we end up
yes.
with 7 companies left standing, in the, right?
Plus a broke central bank.
Plus a broke central bank. Okay, because all right, I want to pull in that thread, but I want to get this other question out first, which is, if indeed inflation remains a problem for longer than the market currently expects, if the Fed is forced to keep interest rates higher than the market currently expects, God forbid if the Fed is forced to start hiking interest rates, you know, as we all know that the Fed controls the short end of the yield curve, at some point do the bond vigilantes get involved and say, look, Fed, you're not up for the job. I'm going to demand higher yields in the long end of the curve now because I want to get paid for this risk. And does that just make the systemic risk even greater because now you have even higher interest rates across the yield curve?
Yes, that would not be helpful, at least not to the corporations or the businesses or the banks that pay these higher yields. You know, the fact that the bond vigilantes have really not shown up, the fact that the long end of the yield curve has remained relatively well behaved, is a sign, I think, of the reasonable risk that today's inflation might devolve into a debt problem, which would inherently introduce the risk of falling prices and not rising ones. That is to say, a debt deflation. You know, it so sounds as if one is talking out of both sides of one's mouth when one begins talking about inflation that introduces the risk of falling prices. But can imagine a case of recession and a case in which market is suddenly concerned about not so much about rising prices, but about unpaid debts.
Mm-hmm.
And pricing power vanishes, and CPI registers 0 point something rather than 4 or 5 point something, and so all of that is out. So that risk might be in the back or indeed the front of the minds of the world's bond markets. But what's going to be an interesting laboratory in the anticipated arrival of the bond vigilantes is what's going on in Japan. The Bank of Japan has done the most astounding things with regard to interest rate suppression and debt monetization. Is the laboratory in what was once regarded as monetary heresy now is kind of mainstream. But the 10-year Japanese government bond is now yielding 1 point something, 1.07 or something. People thought it would never happen. A 1% yield in Japan, my goodness. But the rate of inflation in Japan is now kind of persistently registering 2% plus. And so one has to wonder what happens in Japan if my friend David Dredge watches these things from Singapore. He's a student of Japanese monetary matters and a dealer in very exotic, mathematically charged options that will help exotic people profit from unexpected outcomes. And David has a way of taunting the Bank of Japan. He says, apropos of the years-long campaign to generate inflation, he said, what if it works? What if it works? And it is seeming to appear that it has begun to work. And you have to, so if inflation takes root in Japan, what does that mean for the world's bond markets? I don't know. I'm throwing it out. I thought perhaps you and Adam could answer this, but it's something we're wrestling with here at Grants.
Oh my goodness. I'm so sorry, my
There's a
friend.
phrase in the Bible says, sufficient unto the day. We might leave this one for next week or something, but that's something we're thinking about is what happens in Japan if inflation actually, if the central bankers get what they profess to want, which is lots of inflation. All right, fellas, enjoy.
Well, I mean, in many ways, that's what the Fed got, right? I mean, there were lots of headlines, Yellen and others say. I think that was like one of the greatest regrets she said she had about her tenure is that she couldn't get inflation up to the 2% target. The Fed finally got the inflation it wanted.
Remember in 2020 at Jackson Hole, the chairman of the Federal Reserve Board said we are now going to resolve to get our 2%, and to ensure that this is going to happen, we are going to compensate for any shortfalls from 2% by allowing it to rise above 2% just to compensate. So, at the time I thought, do they really want to do that? Are they summoning the gods of the irony? And I mean, do they want this? And they said they did make it. So H.L. Mencken said American public electorate gets what it wants, good and hard.
Well, we're definitely getting that on inflation right now. So let me ask you this. You mentioned recession there briefly, right? Which is, and this is sort of a big question I wrestle with is, while I see the secular reasons why you're saying you think inflation is going to remain higher than maybe most expect right now, if the lag effect arrives good and hard enough, right, it could definitely push us into recession, at least for some period of time, where you would expect the U.S. Treasury bond market to get the safety bid. So, could we have this long-term secular trend of rising interest rates ahead of us measured in decades, but in the relatively near term, next year or two, if we fall into recession, have a transitory period of lower yield?
Right. I mean, if you look at the history, for example, of the 1946 to 1981 bear bond market, there was 35 years of persistently rising rates, falling bond prices. There are plenty of false dawns in there. I recorded some of them falsely and hopefully. So in 1979, mind you, there's 2 years before the top in yields, long-dated treasuries yielded 9%. Nothing like that seen since the Battle of Gettysburg, when survival of the Union was in doubt. All right, that's the top. Nope. Nor was 10 in the spring of 1980. Nor was 11, 12, 13, 14, 14, then 15. And at 15%, don't you know that the great and the good of Wall Street saying, nope, that's not the top. So yes, but something else to watch for is the safety bid. Recall in 2020, in March 2020, most unscripted and unexpected fashion, the Treasury bond market had a little setback as the world was going to hell in a handbasket. It went down in price and up in yield, not the opposite. And the Fed came in and announced it was going to buy all the treasuries it could stuff into its safe for the safe and the smooth functioning of the Treasury market.
Yep.
By the way, this brings us back a little bit to the thing I rammed into our conversation without you asking, which is the hypothetical evident, the ocular insolvency of the Fed, not substantive, I should quickly add, but it does matter for many reasons, not the least of which it explodes the concept of the independence of the central bank. How can a central bank be independent of the Treasury, to which it is indebted to the tune of 3 times its stated capital? It can't be. So I think that there is one of the themes of recessions of the future might be what's going to happen to the safety bid. Is the world going to rally? Probably the world will want Treasury bonds as a port in a storm, but could there be a storm in that port? It has happened before. It happened in 1931 to 32. There was a period of 9 months when treasuries went up in price and down in price and up in yield because the world was worried about the dollar, about credit, the Treasury. These are very rare historical instances, but these are unusual periods with respect to the public debt and with respect to the attitudes of the government towards the public debt, which is one of kind of indifference.
Okay, so obviously the question I want to ask, and I guess I'll ask it now, even though there's some others I want to make sure we get to, is so if the U.S. Treasury becomes less of the safety trade that it historically has been, what do you think? Where do you think capital seeking safety is more likely to go? Gold?
Oh, I think that's one destination. One of the things I never believed that water could be a major retail product. Some people years and years ago, first people who walked down the street with a bottle of water in their hands, such as a fashion accessory. There's a tap. There's a tap inside, right in that house. It's free.
Yeah. There's a water fountain right there. Yeah.
So the same thing with the cryptocurrency. There's $2 trillion plus of this of invisible value in that world. I never had a concept that there would. So having failed to foresee either the boom in water before people got seriously talking about the geological difficulties with the water supply, with water and with crypto. So one is a little bit humble before the possibility of asset classes that are yet unfavored. But I could see corporate bonds paradoxically tightening during a crisis rather than widening because the world is more comfortable with the credit of something like Apple, for example. These spreads are now unusually tight. So there's that possibility. Who knows? Maybe there's going to be some up and coming nation that's going to be make a name for itself in the realms of fiscal disciplines. I don't know, but nothing. If there were a permanent fixed safe asset class. If there were a permanent world reserve currency, the pound sterling would still be that currency, or maybe I don't know, maybe um, uh, uh, the great Solidus from the Byzantine Empire gold coin that held sway for 600 years. That would still be the world's money. So these things, um, the favored asset classes, the favored currency, the movement in these asset classes can be glacial, or even slower, it seems sometimes, but favorites do evolve and change. And nothing says the United States has to hold this world currency, the Coca-Cola of monetary brands forever. In fact, I think it's become rather a poison chalice, consuming much more than you produce and borrowing the difference. That has, I think, not served us actually well as a producing nation.
Right. Griffin's paradox and all, yeah. Okay, so all right, we're beginning to get a little tight on time, so I'm going to start moving into a little bit more rapid fire questions here. And I hate to do that, Jim, because it's such a privilege to be able to pick your brain here. Given higher for much longer, do you expect the economy to grow slower than perhaps most are expecting right now?
Oh, I don't know. I think that these macro things are often turned on the seemingly facetious or trivial proposition that whoever is going to surprise the most people is going to be the likeliest outcome. I long ago stopped being dogmatic on these great macro questions, except for a couple of interest rate sidebars I've allowed myself.
Okay. Well, let's see. Maybe these fall in the same category or not, but we'll see. So we talked about the commercial real estate market, which is under a lot of duress. You said it's under much more duress than other parts of the commercial, I guess other parts of, I'm trying not to say commercial real estate because that's what CRE stands for, but you said retail is not quite as bad and hospitality, et cetera. But how about residential real estate? This is one of the things, again, that has just really flummoxed many people, myself included, is we had mortgage rates, double. And yet we're still clocking in on average all-time highs on national housing prices right now, right? And
it's worldwide. There's much the same phenomenon is apparent all over the place. I think it helps when you think about your house is to ask yourself, could I afford to buy it? And that holds true in other places in your neighborhood. Can the people live in these places, could they afford to buy it now? And to realize that a house is not so much an asset as a cost center. If you're honest with yourself, it
takes money out of your pocket. Yeah.
Yeah. So I think before we all go crazy by counting ourselves as house rich, we ought to face the fact that it's really it's a cost center, and it's a fat, but there aren't enough of them. Am I talking in circles on this question?
No, you're not. But let me just get to the crux of my housing question, which is, I talk to a lot of housing people, and I can understand at this point in the story why home prices have been supported on average, and it has to do a lot with inventory, but also probably more so transaction volume, which is just dried up. And you also have we haven't gotten into this territory yet, but we've had it's so interesting. We low interest rates exploded asset prices higher. That made the wealthy wealthier faster, and so we have this wealth disparity. And now that we have high interest rates, in many respects, that's made the wealthier even wealthier, because now they're getting a fat 5+% on all their cash. And the markets, because of all the deficit spending, have boosted asset prices. And so it doesn't seem to matter whether interest rates are low or high. It just seems to be really good for the wealthy. And they're buying up a lot of, with the reduced transaction volume, it's mostly being most of the transactions right now are people who are price insensitive and have lots of money and can put cash down, which is supporting the system. But at some point, do you think that these higher for much longer interest rates are going to weigh so much that you're going to have people starting to having to sell, and then we get more volume, and then price maybe finds a price discovery, more true price discovery happens?
Yes, I think that's a likely outcome.
Okay, good. Again, I love it that you will just give it to me straight. Last question is jobs. I think one of the things that's been holding the economy together has been the resiliency of the employment market. Quick side note, I think there's a lot to question in the official BLS jobs numbers. I don't think it's quite as rosy as we hear in these monthly job reports, but it's not terrible. But if higher for longer interest rates persist for much longer, you would think at some point that's consumer households are going to start buckling. That's going to start reducing consumer spending. As margins compress, companies will be forced to finally start laying workers off, and then that could potentially be the domino that sends us into a recession. How worried are you about that?
I mean, there will be a recession. There will be a moment at which you can't imagine anything denting this marvelous labor market. And that will be the moment that begins the cascading to the downside in the jobs numbers, or the levitation in the number of unemployed. It just turns, it seems, when it comes to it seems to turn on a dime, and it trends, it moves very fast and very frighteningly in the wrong direction. So that cyclical moment will certainly come. To deny it would be to deny the inherently cyclical nature of our enterprise, of our economy. So yeah, I don't worry about it per se. As a chronicler of these cycles, I worry that there will be no drama. What's the worst thing for financial journalism is peace and quiet. That's what worries me.
Something to not be able to write about. Yeah. Okay. And I think you've answered the spirit of my question, but part of it is, and I'm not asking you for any time predictions, but just from my mind, I think of higher for longer. The more you extend it, the more it just becomes a math equation, which is, yeah, at some point, more and more players are going to have to start checking out because they're stumbling under the weight of those higher interest rates. And then at some point, you hit a critical mass where a recession just becomes inevitable if this plays for long enough.
I think that's exactly the dynamic. But my goodness, I expected to begin long before this. So we're asking the wrong guy the when question.
Yeah, well, just to be clear, I'm specifically not asking you the when question. It's more just the
Yeah, but you were kind of hoping that I'd have a date, though. I know that.
No, I know you enough. I wouldn't do that to you. But that being said, I will ask you this zinger, which I know many folks don't like to be pinned down on. So feel free to evade if you want, or check your swing. But in this environment that you are now projecting, are there particular asset classes or investing strategies that you think are better suited to that environment?
I think liquidity is a wonderful characteristic to bring to one's portfolio at this moment. I think everyone, let me try this again, if I may, Adam.
Sure.
I think that there is a compulsion to be fully invested nowadays. What doesn't look good? Stocks go up as if that were their job. Bonds aren't so very bad. I mean, you can reinvest at higher coupon levels. Very important, but little regarded aspect of a rising rate environment. Cryptos go up even on the weekends. So I think my old mentor, Bob Bleiberg at Barron's, the editor of Barron's, would say, if you can identify a strong consensus of opinion at least investigate the attractiveness of fading. And if it's hardened and if there's value on the other side of that consensus, at least consider. So I think that I can identify a consensus of opinion, which is to be all in. And I think that the way to fade that is to look for out of the way equity situations, if you're interested in stocks, things that are not so much under the likely to be stampeded in case that people decide to deny their index funds. Value is yet going to have its day, so we continue to believe that that so far unrepaying mantra that value will have its day. I think that gold is going to do better in a time of warranted doubts spreading and warranted doubts about the judgment and the methods of modern central banking and the currencies that the central bankers produce in such profusion. And I think that that cash is going to continue to do pretty well. I think that nothing wrong with 5% if you're being paid to wait in a liquid position to profit from the opportunities that a future bear market might have. I think, oh, that's good. So that's the way we're approaching things. The great Evan Lorenz, the deputy editor of Grants, is a fine securities analyst, and he finds a lot of small and attractively priced situations, paradoxically appealing things. We came up with a former coal miner that has got into the power business and is priced as if we're going out of business, which it isn't. It came up with a dry bulk shipping company that's priced as if it were going out of business. We have reason to believe it's not. So that's the way we approach things. We don't take so much a macro view of the stock market when we observe that it is very highly valued, but we constantly look for things that have fallen between the cracks and that are appealing in good times. And we hope they will be also rather appealing in not so good times.
So thank you. That was wonderful. To your very last point there, is it fair to say that you at Grants are favoring a more active approach to investing versus the passive approach that has really come to dominate over the past?
Yes, but we're certainly talking our book in that regard. I mean, this indexation does us no good as a business. If all you needed was the 1-800 number for Vanguard, you wouldn't actually need to read what we work so hard to produce. So yeah, that's our book, and we're talking it and writing it.
Okay. All right. And just so you know, that is echoed by many of the experts that I have on this program, which is just that the passive playbook, which has worked so well, is highly likely not going to work as well going forward. And it will be a return to the old kind of gumshoe. You got to look at individual companies, look for the,
Yeah, let it be so.
Right. Well, my friend, this has been wonderful. Thank you. I've got two last questions for you. The first one, very important, which is for folks that have really enjoyed this interview and would like to follow you in your work, Jim. Where should they go?
Well, when you go on the World Wide Web and you Google up Grants, don't go to Grants' tomb. That might be the first thing. Go to Grants' Interest Rate Observer, and we hope you enjoy what you find there.
All right, great. And Jim, when I edit this, I will put up the URL there to your website right on the screen too. Folks, I'll have a link to it in the description below the video too. And then the last question, Jim, you've had a illustrious, highly successful career. You've been around the block longer than many people, and I mean that in a very good way in terms of the expertise that you built up. You've been a master craftsman of your craft. What's a big lesson that you've learned along the way in that journey that you think is worth sharing with the audience here? It could have been something one of your mentors imparted along the way. It could have been something the School of Hard Knocks has beaten into you. But what's something that you think is worth imparting to the viewers here?
Well, I am certainly an alumnus of the School of Hard Knocks. One thing I've learned is, or have tried to come to terms with, is the simple adage of "Don't be so sure."
Mm-hmm.
And and you have to be sure of something. So you can't go through life in this pose of eternal skepticism. You would be a most uninteresting dinner partner, let alone a most unhelpful intellectual guide to investing. So, what do I mean by don't be so sure? I mean, don't dogmatize. Be sure you've investigated the other side of the story, and never forget that it is a probabilistic world and not one of certitude. And,
Very well said. And I imagine, and don't let me put these words in your mouth, but I imagine that you would say, especially when you're making a decision based on a lot of conviction, that you investigate having some sort of hedge just in case your main thesis does turn out to be wrong.
oh yes, one of my Wall Street pals, and certainly a most accomplished investor, Paul Singer, has built a very successful business on. He's taken the don't be so sure to the point of view of many billions for himself and for his and many more for his very grateful partners. So again, you have to proceed with conviction, having recall that is you can well be wrong, and having investigated every reason why you might be, and then just say to hell with it and you go for it.
Right. Well, there's the humility, right, of the old Mark Twain quote, right, of it's not what you don't know that gets you into trouble, it's what you know for sure that just ain't so. So, to be an investor, you have to make decisions, right? You got to be along something,
Yeah.
but you should have that eye open saying like, okay, I at best, I got an 80% probability here, so I got to do something about that 20% risk. Yeah.
Indeed.
All right. Well, Jim, it's just been a fantastic pleasure as always. Thanks so much for your time.
I'm certainly
Really
glad you got out of the buy low and sell high business into the interview business, because it's been a pure pleasure to be with you, Adam. So thank you.
well, thank you, my friend. Look forward to having you back on the channel again very soon.
So long, Adam.
All right. Well, now's the time of the program where we bring in the lead partners from New Harbor Financial, one of the endorsed financial advisory firms by Thoughtful Money. This week, I'm joined by Mike Preston. John Lodra has the week off. Mike, great having you on, buddy. Boy, what a great discussion with just such a great gentleman.
Great discussion, Adam. Jim Grant is a legend on Wall Street. He's written the Interest Rate Observer since 1983, I guess. So he's just a legend, and he's been around. I've read his stuff throughout the decades, and I too have been in this business for well over 20 years now. It's amazing how time flies. I was really fascinated by his take on interest rates and bonds, and really interest rates are a very important variable in the financial system, basically drive everything. Low interest rates create speculation, expansion, and investment. High interest rates, the opposite, or at least it has been historically. You were asking Jim about, well, gee, how come we haven't seen a real estate crash with interest rates back up at 7+%? It's puzzling. Now, this lag effect is very laggy, right? As you talked about. I don't think that anything has changed. I think it will all matter. And I think that we've all been humbled about our ability to time when it matters. There's a lot of things that I want to talk about today, short-term concerns, long-term concerns, and it just hasn't mattered yet. We have a massive bubble of speculative blow-off in the market, certainly in particular stocks, and yet it doesn't seem to matter. So maybe we'll share some charts a little bit later, Adam, if that's okay with you.
Absolutely.
So I'd like to just recap some of the things that I heard Jim talk about. There's so much good stuff in here. But essentially, he says the interest rates are going to be higher for much longer. I can't disagree with that, but I think the path will be different. I think we disagree a little bit on the fact that interest rates here are close to 10%, or they're close to 5% on the 10-year. They're roughly, God forbid, they're 10%. If they were, we'd have a big problem. We may get there. But they're about 4.6, 4.7% on the 10-year. And they could very well be going to tag 5% again. But here at New Harbor, we think that rates are likely to go down, at least in the near term, 0 to 2 years, let's say. I think that rates will go back down sub 3% on the 10-year. I think that'll be a function of an asset price crash and a Fed pivot. The Fed's going to have to do something. It could be yield curve control. It could be a lot of different things. But I do agree with Jim that long term, and he talks about the real long term, long beyond the time that we will all be here, that interest rates will be higher, much higher, and that these are secular long term trends. You know, the 40-year declining interest rate environment is over, and ended about 2 years ago when we saw less than 0.5% on the 10-year. We saw a bunch of worldwide bonds in negative territory. So probably he's right, higher for longer. It's just that we think we're going to see yields drop first over the next year or two. So there's a trade to be had there in long-term bonds. TLT, for instance, is a position in our portfolio, not a big one. It's only about 7.5%. I wouldn't be surprised to see yields go back sub 3% on the 10-year, TLT 120 plus. But long-term would not want to be holding it past that. And you know, he even said it's not out of the question that the Fed raises rates. Who knows? I don't really think that's going to happen. I think that's a long shot. The Fed's very concerned about inflation. Neil Kashkari came out and said something about it yesterday as well. It's really funny they're so concerned about inflation because the Fed talked for so many years about needing inflation. The Fed wants inflation, and I think as Jim Grant talked about, it's kind of what were the words he used? I can't recall what the words were, but he basically said that it's kind of a what did he say here? He said I can't find my notes. I'm sorry, but he basically said it's kind of a lie. It's kind of a yeah, everyone needs inflation, but the fact is that they really couldn't get inflation when they wanted it, and now that's all they're worried about. And so we're just all so focused on this dual mandate of low inflation and stable employment that the Fed has. And really, it's not a good thing for us all. In fact, this is probably a good time to bring this up. You and I were just out south of Los Angeles, and a guest at that meeting gave me this silver certificate here, which I thought was really interesting. His name was Mark. I won't share his last name, but he handed me the silver certificate, and I haven't seen one in a long time. We went off the gold standard completely in 1971. This silver certificate says Series 1957. But up to a certain period of time, you used to be able to take this, go into a bank, and get presented with silver. You know, that's so far beyond all of our lifetimes, we forgot about it, but it's pretty amazing.
And when you hear of the term gold window, or silver window, it was literally referring to the teller window at the bank that you could walk up to and exchange those paper notes for the requisite amount of precious metal.
Yeah, it's pretty amazing. It would be nice to get back to a system like that, wouldn't it? Where that we had honest, free money. It's pretty impossible. We haven't really wanted to compromise our way of living. We, as probably everyone's aware, we started exporting jobs for the last 30 or 40 years. And because of cheap labor around the world, we were able to enjoy a better lifestyle than the rest of the world. Our ability to do that has somewhat been impinged. We've been able to kick the can and continue to keep our lifestyle because we've got the world's reserve currency, and we can simply create inflation and create debt, which is now 34 trillion national debt and growing, close to 3 trillion a year. So it's not really a completely honest system, and I think that we're going to pay the price for that. But the Fed really has no choice. And the message from Jim is that we're going to have higher interest rates for longer. I think that's true, but we're going to have some kind of economic crisis or crash first, in my opinion. One or two other things here I'd like to say. He's absolutely right. The Fed is hypothetically broke. You know, they've got 43 billion in capital, and some writers like John Hussman's been out there writing, and some others have said that they estimate that the Fed has lost over $1 trillion, maybe $1.5 trillion on their balance sheet since March of 22 when rates went up. It doesn't matter because they simply pass those losses over to the Treasury that Jim Grant talked about. I mean, that's wrong. Those losses are public money, losses from our future that we didn't really vote on. But it's just the infinite power of the Fed is there. And some would argue that they have to exist. I would argue that they've gone too far. And the cost of what they've done is going to be really bad. So I guess in wrapping up, and I'd like to talk maybe about the market a little bit later, but in wrapping up about what Jim said, What he recommends is similar to what we recommend. Liquidity, cash, treasury bills, gold and silver are breaking out. We can talk about that a little bit later. He did mention value stocks, and we have some stocks as well. There are pockets, particularly as the market is still trending up, that makes some sense. But for the most part, we agree that liquidity and gold make a lot of sense here, and wait for better opportunities.
All right. Well, liquidity and gold, that's pretty much straight from Jim's mouth there too. But one thing you said about, you know, sort of the unfair advantages, or what did you say, the dishonest parts about our monetary system. Yes, we have been forcing a lot of the rest of the world to pay, for our money printing and inflation. And this is not just recently, but over many decades. But of course, one of the things that we do with the current system we have is we are also stealing prosperity from the future to enjoy it today. I mean, it's essentially what debt is, right? And so we are diminishing the prospects for our future progeny to be able to enjoy that today. And I think we're at a point in the story now where we're really beginning to see the price, the cost of that here in living generations, right? So, it's one of the reasons why we talk so often in this program about the very understandable frustrations that younger generations, millennials, Gen Z, are feeling right now that, hey, we don't have the opportunities that the generations that came before us did. And even amongst the older generations, yeah, they're doing fine on average. But if you look at the median side of things, even they are increasingly struggling. So I just mark this as a part of the story where, like, the piper always has to be paid. There's no eternal free lunch here. And we are now all living in the part of the story where we're beginning to see the consequences of this long-term profligate and unfair, system that we've been letting play out to our, America's great advantage up until now. So anyways, Mike, we could talk about that forever, obviously. Okay, so you said you wanted to talk a bit about what's going on in the markets right now. What's got your attention?
Adam, let's talk a little bit about both the stock market and the gold and silver market. I'm going to go ahead and share my screen here, show a quick chart of silver.
Right, which is broken above 32, right?
Yeah, this is as of, I guess, a half an hour ago. It's at about 32.40 right now. Here's a daily chart of silver. So it's broken out from the low 20s where it was for a long time, and it's broken out handily. Last week touched 32.50. Just, I guess this was Friday.
Right, and sorry to interject, but I mean, silver hasn't been above $30 an ounce since 2013, 12. Long time.
It's been a long time, and I can go to another longer term chart in a moment. I just pulled this one up because it shows the actual spot price. And just a few days ago, we touched 32.50 and went right down to 30. It was a big pullback. And it looked like, well, geez, it's over. Here we go again. The gold and silver bulls are going to get discouraged. I can tell you, I've had a number of people that I've talked to that are long-term bulls that are getting a little skittish, maybe even myself included, which is a bullish sign.
Yeah, like as a long-term holder myself, I don't fully believe in this breakout yet. I'm so glad it's happening, but I'm not going to let myself really emotionally commit to it until it's much further higher than it is now.
Well, absolutely. I mean, I would say don't over concentrate. You don't want to give yourself, anxiety or not be able to sleep. But there's a quick pullback. We're immediately back to 32.40 or so. I believe the short-term target on silver is 34 to 35. We might even get there in the next couple of days. I think that longer term, it's going to go a lot higher. I can share another chart in a moment, a longer term chart, but the bottom line is it's bullish, and even the perma bulls are somewhat skeptical. That's a good sign. The all-time high in silver is 50. It's probably going to get there, but I think the new range for silver is somewhere around 34, 35, something like that. Gold and silver stocks have performed really well, but they're still lagging. I could show you other charts on that, but I think you just have to take my word for it. They're lagging. I expect them to pop and to catch up here at some point. The belief is just not there. The bulls in this sector have been so battered for so long that really believe the rally. So there's this
Yeah.
wall of worry going on.
We're like the lion in the cage that's just been beaten and whipped for so long that even though the cage door is open, he doesn't believe he can get out, right? Spirit's just been broken.
Absolutely. So it's a good thing. And again, if you have an over concentration, which a lot of people do have, now would be a good time to lighten up. There's no way, or maybe very slowly, dollar cost average, if you're over concentrated. If you're not over concentrated, just stay put. And that's different for everybody, the right allocation, but somewhere around 10% of investable assets is where bullion should be. You could have another 10% in mining stocks, but anything north of that, if you had 50 or 75% and you're feeling anxious, now would be a good time to start layering out slowly. If you don't sell into the rally, you're going to feel frozen and you're going to feel like you can't move. If this is a real bull market, and I think it is, the best thing to do is to sell slowly on the way up if you're overexposed. If you're not, just sit back and let it work for a while.
Yeah. Hey, let me ask you this, and maybe this is a topic for delve into at a later video, but uh, when gold and silver hit their last all-time highs, gold got to like 1900 an ounce and silver got to 50 or 49 something, right? Well, now gold's at 2400 or 2350 around the time we're talking here, right? But silver's still down, like you said, it just cracked above 30. You would think that silver, if that ratio that we saw last time they hit all highs were to sustain, I mean, that would be more like I don't know, $60+ silver at this point in time. I guess two questions for you. One, do you think silver's just on a delayed reaction here, and we'll simply see that ratio it just get back to the same gold silver ratio that we saw in the past? And in answering that, I just want to note that when I interviewed Ronnie Stafferly last week, who writes the 400+ page annual In Gold We Trust report, which just came out, which is why I interviewed him. He said he thought, yeah, gold might take a bit of a breather here because it's run so far so fast. But one of the other factors he thought it might take a little bit of a breather is because it's gotten so expensive that in places like India, which are some of the highest gold purchasing countries of the world, the populace has now shifted to buying more silver. And that should be quite silver favorable, I would think, as well. So what do you think?
Yeah, let me share a quick screen of the ETF SLV. It's an easy way for me to show a long-term history here. Can you see this chart now, Adam? Should be up.
Yep.
So we've been talking about this a lot of time on this program. This is the high that you talked about. This is pretty close to the spot price of silver, though not exact, because this is SLV. But you're right, silver hit 50 back then. And it's hard to say. Some of this might have just been because it's a very thin market. Maybe sometimes when I see vertical spikes like this, Adam, I almost mentally just delete them, almost just chop them off. And maybe it should have been something like 40, really, So that's kind of hard to say. It's a very thin market and you can move it fast. And a lot of people probably remember the famous Hunt brothers cornering the market back in the 80s. And one of the reasons is because it's a thin market and you can move it a lot.
Right. Which, sorry to interject, and I totally agree. All I want to say is it's still a thin market, relative.
It's still a
to
thin
gold
market,
and other
right?
things.
You get the right number of people buying it and or covering shorts, it can move. So look at this over here. We've got 4 years consolidation. This is a triangle consolidation, a bullish triangle because the trend is slightly up as it's forming. And we talked about this a lot, that we thought it was likely to break higher. Now, triangles can break both directions, but we thought it would break higher, and it did. So look at this on a monthly chart basis. We've now cleared the high of this old consolidation. A rule of thumb in technical analysis is to take the height of the triangle, add it to the breakout. So the height of this triangle is roughly 10. You'd add 10 to 27 maybe, and you'd be up at 37. Now, it won't get there in a straight line. There's all kinds of different technical things we would look at. But short term, I think this asset's going into this range, 30 to 32, longer term up to here. Now, whether it takes out that high or not, I don't know, because I think some of this was probably what we talked about before. And if you compare this to gold, you'll see that gold has a neater looking chart. This is the 2011 high, this 10-year roughly consolidation with a cup and then a long handle. And then boom, it jumped out on a monthly basis. You can see that gold is actually down about $15 today. Silver is up. Silver, from a relative strength basis, is acting better. I believe gold is going to hit 2,500 relatively soon. You just mentioned it's at 2350. And I think silver goes to 34 from its present 32. And I think that happens maybe within days. That's the way it's looking right now. And then longer term, they both go much higher. Now, silver, yes, will give you, going back to that chart, it's going to give you a better percentage bang for the buck. It's also riskier per se, but the current ratio of silver to gold is around 676, I think, down from 85 a month or two ago, down from 120 a few years ago. And I'll stop the share here. That ratio should go lower, below 60. Long-term average would be more like 40, 50. And I know that some readers or some viewers will say, no, long-term average over 100 years is 15. That's true. I don't know that we ever get back there. I think we will definitely get back to 50, 60. So long story short, silver is the place to be even now if you've got the stomach for it, and just enjoy the ride.
All right. Yeah, and I'm glad you mentioned the stomach for it. So for folks that are getting potentially interested by this, just remember that the precious metals are a volatile asset class, silver much more so than gold even. So if you do decide to put money at work in this space, you got to be fully emotionally committed to riding the highs and the lows. And as someone who's done it for a long time, the lows can really, at times really try to emotionally buck you off. So just be prepared for that.
Absolutely.
All right. So in starting to wrap up here, Mike, you mentioned that you've got some concerns about current market, or you've got many concerns about current market valuations. And of course, the timing of it all is the hardest thing to predict. And in fact, I think in many cases, trying to predict the markets is just a total mugs game. And it's much more of a risk management play, like Jim and I were talking about. So what are you guys doing right now in your portfolio, given your current market outlook?
So believe it or not, I know it sounds that we're bearish and we're predicting a crash, which we are, but still we're 40% general equities, another 10% gold stocks. We're about 50%, including gold stocks, equities. And we've got some very good hedges. We've got some options in place that takes off very quickly, about 25% of those equities. But that doesn't mean there wouldn't be some kind of deductible in a crash. And we have to assume some kind of deductible. But it would be in the order of a few percent. Hopefully, that's what we've got the stomach for. That's what we think our clients have the stomach for. So you can't have your cake and eat it too. We will continue to underperform the S&P if we get the continued melt up that many expect, and even we probably expect a little bit more of that at this point. But still, only about 50% with hedges, about 25% mathematically if you figure out what would ultimately be the exposure on a very quick drawdown or a quick drop in the S&P. So valuations are hideous, ridiculously high, and they have been for a long time. There's so many reasons to be concerned. John Hussman, somebody we have a lot of admiration for, came out with a rare interim report yesterday, a warning, basically saying that from a technical perspective, things are very concerning. The narrowing of the market has been very noticeable. In fact, he points out in his piece that when you have new lows expanding, even 2 or 3 or 4% of the market, as the market's hitting all-time highs, that's a concern. The NASDAQ hit an all-time high in the last week. The S&P did too. But I can show some charts if we have time. The Russell and the Dow are relatively weak compared to that. So there's new lows expanding. It's all about NVIDIA and only NVIDIA here. And last Friday, I think it was, both the NASDAQ and the S&P had what looked to be a bearish engulfing day. The market opened really strong and reversed. We have not taken out those highs yet. I think we might. So here's the fool's game about short-term timing. John Hussman comes out with an interim warning. There was another Hindenburg omen last week. There's a big CNBC article out about this. The Hindenburg omen has called every single crash, every single market top, including the big ones, including the 1987 top and crash. But it's accurate only about 30% of the time. And this bubble, this market has gone on for so long that people don't even care about them anymore. It's like they don't even care. And it will matter someday. What day is it going to matter? I don't know. My best guess, as the market has just a little bit more to go, a couple more months, maybe a few more months, blow off, and then it rolls over. But we don't pretend to know. And that's one thing that I think Jim Grant said at the end of the talk. Don't be sure about anything. I certainly have learned that. We've learned that. And so we continue to hopefully make a little bit of return as this market continues to do what it does. There's some short-term concerns. They're almost too obvious, to be honest, in terms of the Hindenburg omen and the breadth deterioration. So, I wouldn't be too cute about picking the exact time. I think that for most people, if you're not a professional, if you're not doing active hedges like we're doing, just stay in liquidity, just stay in cash, just stay in treasury bills, have some gold, and just sit back and let this thing play out.
All right. Well said there, Mike. We will have to wrap it up there. Folks, two things. One, if you enjoyed the interview with Jim, would like to see Jim back on this channel again as soon as the schedule allows, please let him know by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. More importantly, if you are looking for guidance on how to position your portfolio, given the outlook that Jim mentioned, what Mike and I have been talking about here, highly recommend that you seek the counsel of a good professional financial advisor who can, understand your own personal specific situation, set of needs, your risk tolerance, all that. Put together a really good customized portfolio strategy for you and then execute it for you. If you've got a good one who's doing that already, great, stick with them. But if you don't, you're like a second opinion from one who does, consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses. To do that, just go to thoughtfulmoney.com, fill out the very short form there, and one of the advisors, perhaps even Mike and his team there at New Harbor, if you would like to talk with them, will be reaching out to you very quickly after that. Also, don't forget, if you're there at thoughtfulmoney.com, you can click the newsletter link at the top menu of the website there and sign up for our free newsletter. All right, Mike, thanks so much for hanging with me for yet another week. I do, as Jim underscored, you get into real trouble when you're making time predictions. So definitely not going to try to make one, but I do share kind of your gut feel that things are likely to kind of get a little more interesting, shall we say, before the year's out. No matter what happens, we'll have you and your partner, John, here week after week on the channel, helping make sense of it all for our viewers. Thanks so much, my friend. Everybody else, thanks so much for watching.
Thank you, Adam. And since you and I agree on that, that probably means the top is in, but we will see. We'll see you next week. Thank
All right,
you.
buddy. Take care.
Bye.